So we're in a recession, but what does all that mean for you as a property investor or developer or buy-to-let landlord? That's what we're covering in this video, so stay tuned. If you're new to this channel, make sure you subscribe, smash the bell icon. We put out 3 videos each and every week, all dedicated to keeping you on top of your property investing game. So what do we mean by recession? Recession, as you probably know, is 2 successive quarters of negative growth. So in quarter 3 last year, growth was down 0.01%, and in quarter 4, it was down 0.3%. So that's a technical recession because we're not growing. The economy is contracting. Now, I don't really know what to say about all these figures. Quite frankly, I think the inflation figures and the GDP growth figures are so largely massaged that they don't really give the true picture. I've talked about the way inflation is calculated. You know, when they say we're at 4%, you know, the real inflation on the ground we know is a little bit higher than that, but they use all sorts of ways of massaging these sort of figures. With growth, it's a similar thing. You know, growth, of course, is a measure of GDP, it's the economic productivity of what the country produces. But you'll be surprised to learn what sort of things contribute to the GDP figure. For example, financial services is actually an output which is measured in these GDP figures. So let me give you an example. You've bought a house a long time ago for £100,000. It's now worth £300,000 and you decide to remortgage it at £200,000. When a bank gives you a remortgage, it gives you £200,000. It has basically created £100,000 worth of money in the economy. And that, believe it or not, counts towards the GDP statistics. So traditionally, we think about GDP as being, stuff being made in a factory or services and that kind of stuff, but it's actually money that's created. And of course, when interest rates rise and there's less remortgaging activity happening, then of course that will also have a negative effect on growth. But that's just one small aspect of how GDP is put together. We all know that the UK doesn't really manufacture too much, and the service sector has been hit by all sorts of things. So what I'm saying is that although we're bumping along the bottom with very, very small official figures showing a contraction in the economy, I think it's actually a little bit worse than that. But what do you think? Let me know in the comments below. Also, smash that like button and share this video with your property friends. So what we have is a situation where the economy is contracting. The official figures say one thing, I think it's a little bit more than that, but it's contracting. We also have inflation stubbornly high. The official figures say around 4%, but I think it's a bit more than that. But in any case, even the official figures are double what inflation should be, which is around 2%. So when you've got virtually no growth and inflation ahead of target, what that is stagflation. And that's something that we haven't really seen since the 1970s. And quite frankly, the government is in a very sticky position. With the current climate, there isn't that much room for tax cuts because the economy simply is not making anything. The only way of introducing tax cuts will be to basically add it on the national debt. One way to encourage growth in the economy is, of course, to decrease interest rates. But the Bank of England, I believe, will be shy to act unilaterally. They usually take their cue from the Federal Reserve in the United States. Once they start to cut, I think they may follow. So I don't think we'll see cuts for a few months yet. And even when interest rates are cut, I don't think they'll fall by anything like what some people are predicting, simply because inflation is still double the target. Well, what does all this mean for property prices? Well, we've had a lot of inflation in the economy, double digit in the past couple of years. And when you look at house prices adjusted for inflation, you find that actually house prices are down on what they were 10 years ago, when you take into account inflation-adjusted house prices. And yes, the recession will lead to a little bit more unemployment, which obviously has an effect on housing demand and that kind of thing. But what we have is such a chronic undersupply of housing in the UK, and the fact that real house prices adjusted for inflation are actually lower than what they were 10 years ago, These two factors alone will make sure that there isn't a fall in prices. My prediction, for what it's worth, is that house prices will pretty much stay at the level they are, and in some areas, depending on local demand, may nudge up a little bit. We certainly won't see any galloping ahead in house prices this year because, of course, this year is election year. And when you have an election year, there's always a certain amount of inertia in the economy by the populace at large, because people want to delay making big decisions, big financial decisions, until they know for certainty what is happening with the political climate. Now, the government of the day is not exactly popular at the moment, and certainly not popular with the general sort of masses, the public at large, and the media sense this. So I think for all these reasons, the mainstream media is going to bang on about recession and doom and gloom, and what with it being election year as well, that's going to feed into this general inertia, which basically prevents people from changing their home and making big purchase decisions, particularly with housing. But as savvy property investors, you will be looking at the fundamentals and you'll be making your investment decisions based on that and not what they waffle on about in the mainstream media. And let me summarize for you what those are. But before I do that, if you're liking this video, smash that like button, tell me what you think in the comments below. Now, first of all, I think sales transactions will be weak in election year for all the reasons I've stated. Properties will take longer to sell. There will be more chances to find bargain deals from motivated sellers this year. When you look at the price you're paying for property and you look at the price today compared to 10 years ago, adjusted for inflation, it is less than at that time. And if you're thinking interest rates are high, just look back to 2007 when interest rates were 6%. Now, adjusted for inflation, house prices are less than they were at that time. Also, rents are up 30% at what they were in 2007. So right now we have a climate where prices are cheaper than they were at the last time buy-to-let rates were averaging around 6%, and also the rental income is actually about 30% higher than the last time interest rates were at 6%. So if you're focusing on the fundamentals of building a portfolio of income-producing assets, now is as good a time as any. Tell me what you think in the comments below. Don't go away without subscribing and smashing the bell icon, because we put out 3 videos each and every week, and I'll be seeing you in the next video. The Baker Street Property Meet is the UK's largest and #1 property investors networking event. The property market is going through monumental change right now, and at Baker Street Property Meet we aim to keep you up to date with the latest tips and tricks and insider tactics to help you keep on top of your property investing game and succeed in these troubled economic times. The Baker Street Property Meet is fundamentally about networking, because it's not what you know, it's who you know. And at Baker Street, we aim to connect you with the people to make your property journey a monumental success. There's no better place to be to further your property investment journey than the Baker Street Property Meet. So make sure you're here, you're connecting with myself and Andrew Roberts, our expert guest speakers, and 300 passionate property people each and every month. See you at the next meet. Get your spot at bakerstreetpropertymeet.com.